Welcome to the USDA Single Family Housing Guaranteed Loan Program's training on closing the loan and requesting the loan note guarantee. In this module, we will review our Regulation 7 CFR 3555 Part C and the Handbook 1-3555 as they relate to loan closing and the issuance of the loan note guarantee, more often referred to as the LNG, as well as closing the loan and the lender loan closing system, followed by the agency review and issuance of the LNG, and then some frequently asked questions as they relate to loan closing and the issuance of the LNG. Finally, we will wrap up with some important and helpful links and websites that we offer to our lending partners to help administer these single-family housing guaranteed loans. Lenders are required to comply with all conditions as noted on the conditional commitment. The loan note guarantee represents an obligation from the United States that is supported by the full faith and credit on which it is issued. It is incontestable unless the agency verifies fraud or misrepresentation by the lender in which they had knowledge of at the time the loan was made. Misrepresentation includes negligent misrepresentation on behalf of the lender. The lender should never close the loan prior to the issuance of the conditional commitment. Doing so will jeopardize the issuance of the LNG to the lender. These next few slides will take a closer look at the requirements needed in order to assist you in receiving that LNG as quickly as possible. Lenders should be closing loans within the required time frame. For purchase transactions, that is 90 days from the date that the conditional commitment was issued. New construction should correspond with the estimated project completion date, but not exceed 12 months. Note that the exception to this is the combination construction permanent loan, or what is known as the single close construction loan option, which is outlined in Chapter 12.12 of our handbook, where the LNG may be issued once the interim construction loan is closed, without waiting for completion of the subject property. A one-time 90-day extension may be granted. However, the lender must request agency approval prior to the expiration date of the conditional commitment. If the exception is granted, the agency will provide approval in writing, and a new conditional commitment will be issued reflecting the new expiration date. The lender is responsible for ensuring that documentation regarding credit, income, assets, etc. are updated as needed. Once the loan is closed, the lender should submit the required documentation to the agency within 30 days for the issuance of the LNG. There are some instances where the documentation may be submitted after 30 days of loan closing under certain conditions. We'll go over that in more detail later in this presentation. Loans must close under the same or better terms and conditions as when they were underwritten and approved as indicated on the conditional commitment. The agency does not require specific loan documents for closing. Industry standard legal documents may be used. The lender must notify the agency in writing of any changes in loan terms or characteristics of the applicant or property from the issuance of the conditional commitment to loan closing. Borrowers cannot get cash back at closing, with the exception of eligible expenses already paid out of pocket. The agency's resubmission policy in Chapter 5 covers changes that would require the release of the application in GUS for lender updates and a resubmission to the agency for re-review. These changes include an increase in mortgage or other liabilities of more than $50, borrowers either added or deleted, decrease in income, decrease in cash assets, an increase in loan amount, or an increase in interest rate. Changes that would not require a resubmission include a decrease in loan amount, a decrease in interest rate, decrease in mortgage or personal liabilities, an increase in assets, or an increase in mortgage or personal liabilities of $50 or less. If the lender fails to obtain approval from the agency for loan application changes prior to the loan closing, it may result in denial of the loan note guarantee. All individuals applying for the loan who will assume responsibility for the mortgage debt must sign the loan application and any addendums. Again, standard industry closing documents are to be utilized when closing the loan. Any individual whose signature is required by state law, such as a non-purchasing spouse, must also sign the security instruments and/or note to create a valid first lien. All owners that will be vested in title must sign the security instrument. Lenders should never ask borrowers to sign blank or incomplete documents. E-signatures are acceptable. However, it is the lender's responsibility to ensure the e-signature is eligible and that it meets all legal requirements. A power of attorney may be used when the mortgagee verifies and documents certain criteria have been met. These criteria are noted on the slide. Chapter 16 of our handbook offers additional guidance for both military personnel and the case of incapacitated borrowers. Again, electronic signatures are accepted when they are completed in accordance to the guidelines as noted in Chapter 15 of our handbook. Interest credit closings are intended to reduce the burden on borrowers whose loans were scheduled to close at the end of the month but did not due to unforeseen circumstances. Lenders and borrowers may agree to credit the per diem interest to the borrower and have the mortgage payment begin the first of the succeeding month. The lender will certify that the loan has been underwritten and closed in accordance with our regulation, and that it meets all conditions as outlined on the conditional commitment, and that all documentation has been submitted to the agency. The lender will acknowledge that upon receipt and acceptance of the conditions noted on the conditional commitment, and the receipt of the required fees in relation to the loan amount, that Rule Development will issue an executed loan note guarantee. Rule development allows for only two forms of ownership: fee simple and secure leasehold. Leasehold interests are acceptable when all of the following conditions are met. 1. The applicant must be unable to obtain fee simple title to the property. 2. Rent charged for the lease must not exceed the rate paid for comparable leases. And 3. The appraisal must document these conditions. Additionally, the lessor must own the fee simple title. Now, this provision does not apply to a lessor who is a Native American possessing a leasehold interest on restricted land. Trust or restricted land must remain in trust or restricted status. In these cases, the mortgage, deed of trust, leasehold interest, or other security interest must be approved by the Secretary of the Interior. Requirements for loans to Native Americans on restricted or trust land states the lender must obtain specific documentation in order to meet the agency requirements. These requirements are detailed in Chapter 16.12 of the handbook. For all other leasehold interests, you will want to note the following. Leasehold estates are an accepted practice and marketable in the area where the subject property is located. Neither the leasehold nor the fee simple title may be subject to a prior lien unless the agency authorizes acceptance of the prior lien before loan approval. The lease must be in writing, recorded, and contain all those certain provisions as noted in Chapter 16.12 of the handbook. And the language regarding amendments to mortgages with leasehold interests, which are specified in Chapter 16, Attachment 16A of the handbook, must be inserted into the mortgage. Guidance for all other leasehold interest properties are also provided in detail in Chapter 16.12 of our handbook. Until loans are paid in full, lenders must ensure that their borrowers continuously maintain hazard insurance on the property. Some items to note: for hazard insurance, the lender must ensure that the policy is in effect at the time of loan closing and must ensure that the borrower continuously maintains the insurance for the life of the loan. The policy should indicate if the property is a leasehold to ensure state laws regarding insurance requirements are met. Lenders should adopt accepted industry standards for hazard insurance, which means hazard insurance providers should have ratings in accordance with the most recent GSE requirements. Policies should conform to the GSE coverage requirements of the Standard Extended Coverage Endorsement, which basically states that a policy cannot be accepted that in whole or part excludes wind, hurricane, or catastrophe insurance, unless the coverage is provided in another policy with the same coverage limits. Borrower-occupied properties should have replacement cost coverage in an amount that is at least equal to the guaranteed value of the improvements or the unpaid principal balance. Deductibles should not exceed 5% of the total coverage amount. Similarly, if a dwelling is located in a special flood hazard area as identified by FEMA, the property must be located within a national flood insurance program participating community, and the borrower must obtain flood insurance. When looking at flood insurance requirements, the lender must ensure that the policy is in effect at the time of loan closing and ensure that the borrower continuously maintains the flood insurance for the life of the loan. The flood insurance must cover the lesser of the outstanding principal balance of the loan or the maximum amount of coverage allowed under the NFIP, and the maximum deductible for a flood insurance policy should not exceed $10,000. The lender is responsible to review all policies and ensure that their requirements are met, and a copy of the policy must be retained in the lender's permanent loan file. Here are some important guidelines for closing and post-closing criteria. Closing date. The date of loan closing is defined as the closing date listed on the closing disclosure. This is the date that we will enter into our system. Duplicate loan note guarantee. If a lender needs to request a duplicate LNG, the lender can retrieve a duplicate from the LLC system. There are some instances where a lender may request a certified copy or a duplicate original, as per some investor requirements. A lender's request for a certified copy, scanned copy, or duplicate original will be honored. Transferring of loans and/or servicing rights. Lenders may transfer guaranteed loans to other USDA approved lenders. Requirements for these transfers and servicing rights are outlined in Chapter 4 of our handbook. Lien position. The guaranteed loan must have first lien position at closing. However, if the lender wishes to permit a junior lien to the guaranteed loan, they may do so if 1. The lien will not interfere with the repayment of the loan and has been considered in the underwriting process. 2. The total value of all liens on the property is less than or equal to the property's market value, except for cases when a soft second for a down payment and/or closing costs creates the overage. And 3, the junior lien is for an authorized loan purpose. Now, let's look closer at the lender loan closing system. The lender must provide evidence that the loan was properly closed and remit the upfront loan note guarantee fee, the technology fee, and all required closing documents within 30 days of closing the loan. Approved lenders must submit all guaranteed loan closing transactions to the agency electronically through the LLC, the lender loan closing system. Requests received more than 30 days after loan closing will be considered. However, the submission must include a payment history as evidence that the loan is current. In addition, the lender will need to certify that all required escrow accounts are current and neither the lender nor another interested party provided funds to bring and/or keep the mortgage current for the purposes of obtaining the LNG. The loan note guarantee will not be issued if a request received more than 30 days after loan closing is in default at the time of the LNG request. The upfront guarantee fee and the technology fee will be paid through the LLC system using pay.gov. If the agency is unable to issue the LNG, the fee may be returned to the lender. Once the LNG is issued, the fee is non-refundable. Lenders should upload the required documents in the LLC system with their request to receive the LNG. These are, at a minimum, the final closing disclosure, the promissory note, and any other documentation as noted on the conditional commitment would be required as well. In addition to the uploaded documentation, the lender will be required to enter basic loan closing information, such as the loan closing date, loan amount, etc., into the system and authorize the electronic payment. Lenders must complete and submit the user agreement for single-family housing guarantee lender loan closing form prior to accessing the lender loan closing system. Individual user access will require a Level 2 e-authentication ID and password. In addition to the approved user agreement for single-family housing guarantee lender loan closing form, lenders must also have an approved Form RD 355516, Agreement for Participation in Single-Family Housing Guaranteed Insured Loan Programs form on file as well. Our USDA Link Training and Resource Library has a lender loan closing user guide available to our lenders. This guide is located under the Loan Closing tab. Lenders can add and/or update a loan closing from the Lender Loan Closing/Administration link on the USDA Link site. Most information will be pre-filled based on information as input by the lender's application and GUS. Additionally, the fee section will be pre-populated based on the loan amount established for the upfront guarantee fee and technology fees. If a loan amount decreases, the upfront guarantee fee amount will be modified when the page is submitted by the lender. The LLC User Guide is a great reference to walk lenders through the loan closing submission process. Data entry for the loan closing is very simple. Most information will be pre-populated based on the lender's input from the application, as well as information as submitted through the guaranteed underwriting system. All editable fields remaining should be completed by the lender. Data entry on this page should match that of the promissory note for the loan. If there is an increase in the note amount or interest rate, the loan will need to be re-underwritten and supportive documentation should be submitted to Rule Development prior to the lender submitting the loan for closing. For processing purposes, it will be treated as a new loan request. Ratios exceeding those already approved by the agency may result in the denial of the LNG request. The fee section is pre-populated based upon the loan amount. If the loan amount decreases, the upfront guarantee fee amount is modified when the page is submitted by the lender. Once all of the information is input into the LLC system and verified as correct, the lender may click OK at the final prompt to submit the closing package for agency review. Once the package has been submitted, the lender will need to upload the required documents to support the request. This is done through the Single Family Housing Lender Administration List section. Once the borrower ID is entered, you may select the appropriate action from the Borrower ID hyperlink, Upload Documents. At the Lender Upload Documents page, lenders can add the applicable documents that are needed to support the LNG request. At minimum, the promissory note and closing disclosure will be required to be uploaded as individual documents. Any additional documents, as noted by the conditional commitment, should be uploaded as separate documents as well. 3 fields are given, but additional fields can be added by clicking Insert More Documents. Once all documents have been submitted, click OK, and all file names will appear beside the document choice. From there, click Upload Documents Completed to finish the process. The lender will receive a lender loan closing confirmation once the loan is successfully submitted to the agency. Now, let's discuss the loan fees. Let's begin with the upfront guarantee fee. The lender will pay the agency the upfront guarantee fee, which may be passed on the borrower and is an eligible loan purpose. A GovDelivery notification will be sent to lenders informing them of any fee changes from the previous year. The upfront guarantee fee cannot exceed 3.5% of the loan amount. The current fee is 1% and it applies to all new loans, including refinance loans. The borrower has 3 options for payment of the upfront guarantee fee. They may finance all or a portion of that fee, or utilize the option to pay for it with their own funds or seller concessions. Lenders will pay the upfront guarantee fee through the Lender Loan Closing System interface with pay.gov. Lenders can refer to the fee calculator that is available on the Lender Link library under Origination. The servicer will electronically pay the agency the annual fee on all purchase and refinance transactions. This fee may be passed on to the borrower. The current annual fee is 0.35% and is calculated based on the average scheduled unpaid principal balance of the mortgage and does not include payments such as delinquent payments, prepayments, or loan modifications. The due date of the annual fee will be the first day of the billing month, with a grace period to payments credited through the 15th day of the billing month. The servicing lender remits the payment of the fee through the guaranteed annual fee system. In addition to the initial late charge provided, the lender may be assessed an additional late charge on any annual fee remaining unpaid after the last day of the month that the payment is due. The additional late charge will be 1% of the unpaid fee amount. Annual fee late charges may not be passed to the borrower. Lenders will pay the agency a technology fee, which is currently $25, for any loan that is processed through the guaranteed underwriting system. This fee is considered an authorized loan purpose, which may be passed on to the borrower and included in the loan amount, subject to maximum loan-to-value thresholds. The technology fee will be collected through the agency's LLC system when the lender submits the loan closing package electronically. The fee is non-refundable once the loan is closed and the LNG has been issued. When the technology fee is passed on to the consumer, it will be disclosed on the loan estimate and closing disclosure as services you cannot shop for / services borrowers did not shop for. Failure to pay the technology fee at the time of closing will result in the denial of the LNG. Lenders must establish a pre-authorized debit account or PAD for pay.gov to submit the upfront guarantee fee and the technology fee electronically. The LLC user agreement that is executed by the lender will designate one or more security administrators. A security administrator may be a lender security administrator or a branch security administrator. The lender administrator role allows the user to add and modify PAD account information for any of the lender's branches. The branch administrator role allows the user to add and modify PAD account information for only the branch that the user is associated with. All administrators must have a verified identity in e-authentication. A PAD is set up through the lender PAD account maintenance link available on the USDA link site. The link is located on this slide. Through this link, the administrator can establish a new PAD account as well as maintain or even delete existing accounts. Again, the LLC user guide offers a step-by-step guidance in setting up and maintaining all PAD accounts. Confirmation of receipt of the required fees can be verified under the Payment History tab through the Single Family Housing Lender Administration list. In this section, we will discuss the loan note guarantee. In order to receive the loan note guarantee, the lender must submit any required documents and certify to all conditions noted on the form RD 3555-18/18E, including any attachments to the form. The loan note guarantee is the evidence of the agency backing should the loan ever default. So understanding the proper procedures and rules of issuance are paramount to ensuring secondary market salability and the note holder's protection. The loan note guarantee is 2 pages. The top of page 1 displays information such as borrower's name, approved lender, USDA case number, randomly generated borrower ID, and principal amount of the loan that is guaranteed. Page 1 also includes the terms of the loan note guarantee coverage in the event of a lost claim, along with the eligible loan purposes that it may be reimbursed for under the guarantee. Page 2 will include the borrower's name and borrower ID at the top. This page also includes indemnification language and annual fee percentage. Other items listed include information on protective advances, termination of the guarantee, and the email address for the Rural Development Business Center Servicing Office where certain actions may be required to be reported. The loan note guarantee represents an obligation from the United States supported by the full faith and credit on which it was issued. It is incontestable unless the agency verifies fraud or misrepresentation by the lender in which they had knowledge of at the time the loan was made. Misrepresentation includes negligent misrepresentation on behalf of the lender. Guarantees are not permitted for loans that are structured for payment of interest on interest. In situations where the note that the loan note guarantee is attached to provides for a payment of interest on interest, then the guarantee is void. However, guarantees are permitted where interest is capitalized in connection with loans that are reamortized. The loan note guarantee will be unenforceable if the lender has a loss due to violation of the regulations, negligent servicing, failure to obtain required security, or use of loan funds for unauthorized purposes. Negligent servicing is defined as servicing that is inconsistent with the regulations and includes failure to perform those services which a reasonably prudent lender would perform, regardless of the guarantee. This also includes the failure to act in a timely manner or acting in a manner that is contrary to how a reasonable prudent lender would act. If the agency determines that a lender did not originate a loan in accordance with the requirements of the regulation, and the agency pays a claim under the loan note guarantee, the agency may revoke the originating lender's eligibility status and may also require the originating lender to indemnify the agency for the loss if the default leading to the payment of the loss claim occurred within 5 years of loan closing and one of the following is present. The originating lender utilized unsupported data or admitted material information, failed to provide, verify, and analyze the applicant's income and employment history, failed to address property deficiencies identified in the appraisal or inspection report, or used an appraiser that was not properly licensed or certified. In cases involving fraud or misrepresentation by the originating lender may be required to indemnify the agency for the loss regardless of how long ago the loan closed or the default occurred. In addition, the agency may use any other legal remedies it has against the originating lender. It is important to note that the loan note guarantee will remain in effect for any holder of the loan who acquired it from the originating lender. This example will help illustrate how loss payment is calculated per Chapter 19 of the handbook. If a loan's original principal amount was $100,000, the maximum loss payment will be the lesser of $90,000, which is 90% of the original principal amount, or the calculated amount based on the second bullet. Let's walk through that calculation. First, we find 35% of the original principal amount, which is 35% of $100,000, giving us $35,000. Next, we calculate 65% of the original principal amount, which is $65,000. Now we need to find 85% of that $65,000. This gives us $55,250. To finish the calculation, we add the $35,000 and the $55,250 together, resulting in a total of $90,250. In this example, USDA's exposure would be capped at $90,000, which is the lesser amount. What is important to note is that this example, which reflects a situation of total loss, is being utilized for the ease of understanding the math of the calculation. The actual average loss claim is less than 35% of the original principal amount, which means the majority of claims end up with 100% coverage of their loss. So it is important to remember that the commonly referenced 90% loan note guarantee refers to a maximum coverage level and not the average actual coverage, which is considerably higher. Now let's move on to the agency review. Here's an overview of the process to request the LNG. Within 30 days of loan closing, the lender must request the issuance of the LNG. As we discussed previously, any requests for the LNG that are received after 30 days may be considered, however, the loan must be current at the time of the request and additional documentation will be required. The lender will certify the loan was closed in accordance with the conditional commitment. The lender must maintain evidence of hazard insurance and, if applicable, flood insurance. Evidence of supporting documentation that the loan was closed properly will need to be submitted to the agency. The agency will review required loan closing documents to ensure that the lender has completed and fulfilled all requirements as outlined on the conditional commitment. For incomplete closing submissions, the agency will grant up to 30 days to correct. Lenders will be notified of incomplete packages by phone or in writing, which is typically done through email. While the lender is responsible for providing the missing or corrected documents, agency staff will work with our lending partners to provide the LNG within the required time frame. If the loan package is not complete within 30 days and the account is in default, then the agency will not issue the LNG. The agency will return the loan closing package if corrections cannot be made within 30 days. For closing packages that are received as acceptable, the agency staff will review and determine the closing documents are acceptable and issue the LNG within 10 business days of receipt. The LNG and loan amortization schedule will be provided to the lender and a copy will be retained in our files. The LNG may be viewed and printed through the LLC system, which we will review in the next few slides. The agency will not issue the LNG for any closing packages that are received with errors in the closing documents, if the loan does not meet program requirements, does not meet all conditions as noted on the conditional commitment, or if the applicant receives cash back at closing in excess of the amount they paid out of pocket for allowable fees. Loan funds and/or seller concessions may not be dispersed to the applicant until the lender can correct the oversights and unauthorized use of funds. If the lender can make the necessary corrections, the agency will re-review and ensure that the loan meets the regulatory requirements prior to the issuance of the LNG. If the agency determines that the LNG cannot be issued, the agency will notify the lender of the reasons and provide a review and appeal rights as outlined in Appendix 3 of the handbook. The LNG may be retrieved from the LLC system under the Single Family Housing Lender Administration list using the Display Documents from the Action dropdown. From here, the lender may view, print, and then retain the LNG in their permanent loan file. It should be noted here that this information is not available to the agency when reviewing the closing documents. This slide, as well as the next several, are a lender view only. Single close construction loans do require an important step for closers and/or post-closers to complete once that the construction is complete. From the three options available, the user will select the appropriate completion type. For loans with remaining funds after construction, you will want to select principal reduction only for your completion type. With this option, you must complete the following fields: construction completion date, principal reduction date, modified unpaid principal balance, and principal reduction amount. For loans with remaining funds after construction with a loan modification, you will want to select principal reduction with loan modification for your completion type. With this option, you must complete the following fields: construction completion date, principal reduction date, modified unpaid principal balance, principal reduction amount, loan modification date, and lower interest rate when applicable. For loans where the construction is complete and will require no principal reductions or loan modifications, you will select construction complete, no principal reduction or loan modification for your completion type. With this option, you only need to enter the construction completion date and upload the lender certification. After closing, the lender must ensure collateral is accurately covered and ensure that all closing instructions have been met. The lender should compare the deed of trust or mortgage with the title opinion to assess lien priority. Although the agency does not set policy for survey requirements, it is the lender's responsibility to ensure an ownership interest that protects the security property has been obtained and retain on file after the loan is closed. Should the borrower default on the loan, the lender must be able to foreclose on the property to settle the debt. If the lender fails to obtain all required security, the originating lender may be subject to indemnification if a loss claim request is made to reflect the lender's failure to meet the lien requirements. In cases where a lender may need to request a duplicate loan note guarantee, lenders may retrieve a reissued loan note guarantee from the automated lender loan closing system. A lender's request for a certified copy, scanned copy, or duplicate original of the Form 355517E will be honored. Many investors accept a certified copy or duplicate original of the form. The holding lender may view the loan through the Single-Family Housing Lender Administration List to assist with loan servicing actions as well as viewing closing documents. Let's review some FAQs that we have received from lenders regarding the closing process, requirements, and issuance of the LNG. A loan closed at a higher loan amount than what was authorized on the conditional commitment. Can a principal reduction for the overage amount be completed? No. Since the loan has closed, a principal reduction is not acceptable. The lender may perform a loan modification to correct the loan amount to match the issued conditional commitment, or request rule development to release the GUS loan back for correction. Property taxes in many states are paid in arrears, which results in a large tax credit at closing. Can an applicant receive cash back as a result of this credit? The credit may be used to pay closing costs, but cannot result in cash back to the applicant. Only costs initially paid by the applicant out of pocket can be returned to the applicant at closing. What options are available when the conditional commitment will expire prior to loan closing? The lender has 90 days from the issuance of the conditional commitment to close the loan with an opportunity for one 90-day extension. The extension must be requested prior to the expiration of the conditional commitment. The lender is responsible for ensuring documentation of credit, income, assets, etc. are updated as needed. An application has been submitted to Rule Development for review. However, a conditional commitment has not yet been issued. Can the loan close since the file has been submitted to Rule Development? No, the loan cannot close prior to the lender's receipt of the conditional commitment. Since a principal reduction at closing is acceptable for borrowers that would be receiving excess cash back, is there a maximum amount that is allowed? No, there is no limit on the amount of principal reduction. However, the lender should determine if a loan modification would be a better option for the borrower. Does USDA allow an applicant to close in a trust? No. The two forms of ownership that are acceptable to the program are fee simple and secured leasehold. Can the USDA upfront guarantee fee be noted as a mortgage insurance premium on the loan estimate and closing disclosure? Although Rule Development does not have a requirement as to how the fee is noted on the disclosures, the preference would be to list the fee on a separate line item and note as a guarantee fee payable to USDA/lender. What is the maximum number of days allowed for an interest credit? Rule Development does not have a requirement on the number of days allowed on an interest credit. The lender's standard protocol is accepted. May loan note guarantees be issued beyond 60 days of the loan closing? The lender must provide evidence the loan was properly closed and remit the upfront loan guarantee fee and the USDA technology fee within 30 days of closing the loan. The blank will pay the annual fee to the agency. The servicer will electronically pay the agency the annual fee on all purchase and refinance transactions, which may be passed to the borrower. What is the maximum that a servicer may collect from the agency on a loss? A, 90% of the original principal amount actually advanced to the borrower, or B, 100% of any loss equal to or less than 35% of the original principal advanced, plus 85% of the remaining loss up to 65% of the principal advanced. The maximum that a servicer may collect from the agency on a loss is the lesser of these two options. In wrapping up this training, let's go over some great tools and resources that we have available to make navigating our guaranteed loans even easier. One useful resource is our frequently asked questions. This document has a lot of useful Q&A as they were received by our lending partners on the program. It is updated frequently and allows for the Control F feature. Our USDA Link Training and Resource Library provides our lending partners a wealth of key information, including current turn times, training, forms, checklists, and all the resources necessary to successfully navigate through the guarantee loan process. You can also sign up for Gov Delivery notifications on this page under the Tools and Helpful Links drop-down tab. Make sure that you sign up for these notifications if you have not already done so. Gov Delivery provides email notifications on important program information such as policy changes, live training events, and GUS system issues. Additionally, you can find contact information for our operations team and all other support staff. Should you have questions on a file that has been submitted or would like to request a status, you will want to reach out to the processing team that handles the state where your property is located. Make sure you follow the helpful tips when sending the email to ensure a faster and more accurate response. Users should always first look for answers to their questions in the regulation and the handbook. But if you still have a question after reviewing these resources, we're here to help. All policy and regulation questions regarding the topic we just covered should be sent to our Policy Analysis and Communications branch. If you have a question on your lender approval or approval for the LLC system, reach out to our staff in the Lender Oversight branch. And finally, if you'd like to request additional program training, marketing, or outreach, contact our Lender and Partner Activities branch. We believe that the Single-Family Housing Guaranteed Loan Program is a great program for low and moderate income home buyers who wish to purchase homes in rural areas. But we know that this program cannot be successful without our partnership with our lenders, so thank you. This will conclude the training module. Thank you and have a great day.